Hello listeners, and welcome to Plugged In, the energy news podcast from Montel, where we bring you the latest news, issues and changes happening in the energy sector. Last week, we saw the introduction of US tariffs, then withdrawals, negotiations and swift retaliation from China. And now we're on to the next chapter of President Trump's tariff news story, as we have seen what many have described as the brutal volatility that the trade wars are having on gas and oil prices. I'm going to be speaking to the head of energy research at financial services firm MST Marquee shortly, but first I'm joined by our Deputy Editor-in-Chief from London. So hi Laurie, welcome back on the podcast.
Hi Richard.
I'm interested to get your views, basically, on how you describe the current sentiment in the gas market following the series of announcements, from the Trump administration, the clear tariff wars that are going on here. What's the current sentiment that you're gauging when you're speaking to analysts and traders out there?
I think there's a lot of caution and a lot of uncertainty still. I think traders, analysts are continually waiting for new news and new information, tidbits from Trump, or just through the news to see what the implications of these tariffs are. Will they be implemented? To what extent? And what impact will that have not only on trade but on the economy and demand, supply? So yes, I mean obviously initially it was very bearish. Prices fell by a quarter or so from Liberation Day on the 2nd of April through to the end of last week, when we had a near 7-week low in gas prices. But I think there's a little bit more optimism now that the negotiations may result in some kind of deals which at least see some better prospect for industry and therefore demand and prices.
So, I mean, are there any positives we can take from the short-term implications of this kind of volatility or the price movements?
Positive, yes. I mean, for gas, to some extent, I mean, it's hard to use words like positive, but obviously we have very low stock levels at the moment, and this is something which we need to deal with. We need to replenish these stocks massively over the next few months ahead of winter. We're down to 35% of capacity compared with 60 or so a year ago. So there's a lot to go. And I think, the IEA released a report last week saying we're going to need something like 25% more LNG this summer to help meet this supply. What obviously this has done, the tariffs have done, have pushed down prices. So, I mean, obviously that is perhaps temporary. What is more structural perhaps is the extent of the tariffs being levied on China and in response on the US from China, which we could therefore see potentially a lack of demand completely from China for US LNG. So we're going to see more LNG coming over here. I think there are already signs that this is happening. And so, yes, we may actually end up having more gas and perhaps cheaper gas as a result of some of this. But as I said before, it's still a lot of uncertainty, and a lot depends on what's negotiated over the coming days, the coming weeks.
But some silver linings, maybe. Thanks very much, Laurie. Now, I'm pleased to welcome back to the podcast Saul Kavonic, Head of Energy Research at MST Marquee. It's great to have you on again, Saul.
Great to be with you once again.
So, you're in the States at the moment. How could you describe the sentiment at the moment, given all the background, the context of this trade war, the tariff announcements, pulling back from the tariffs? What's the actual environment like at the moment in the States?
Well, I was in DC last week, meeting with quite a number of senior, current and former White House officials and members of Congress on this. And I think quite a time to be in DC. State of flux we've seen with the tariff announcements and obviously the movement in those tariffs just over the course of a few days. For someone who works in financial markets, frankly, it's quite a struggle to be sitting through some fascinating meetings, but at the same time seeing on your phone some of the biggest market movements we've seen in decades happening in real time. So there's, I guess, a few things to unpack here. And I'm obviously looking at this, very much from an oil and gas lens. But I think the way industry in the financial markets are looking at this is there seems to be a lot of juxtaposition and in the policy announcements where elements of not just the tariff, but the overall drill baby drill policy approach we've seen from the Trump administration. On the one hand, they're saying go, 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 but there's other signals which say stop, stop, stop. All right. And the oil and gas industry is trying to figure out which is the predominant driver. What we're seeing, obviously, with tariffs is there's implications on the demand side from a global economic perspective. But we're also seeing some very interesting dynamics where tariffs are being used essentially as secondary sanctions to restrict supply from places like Venezuela. We're seeing them being used as well as part of negotiations, which is encouraging contracting activity for US LNG. So we really need to look at both the supply, demand, and contracting behavior that it's driving, and then overlay what the overall deregulatory drill baby drill approach means for US supply and US supply growth and how effective it's going to be. So, I mean, we can delve into a number of these things, but industry itself is both sitting back at the moment to understand how the pieces are going to lie after all of this. And a lot of it also, I forgot to mention, looking at their supply chains with the impact on tariffs from the cost structure, which is very important because, you know, a number of years ago, we talked about, you know, $50 being a floor. But what's the floor these days with cost inflation to date, which is very important for long-run pricing. And at the same time, trying to engage particularly within the US government, but also governments around the world to make sure that they can be positioned better, which of course is all the more difficult when the policy environment is changing on not just necessarily a daily, but almost an hourly basis at times.
I mean, as you said, so there's a lot to unpack, but let's start by maybe looking at how the industry is reacting. I mean, you said, is it stop, 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 or is it go, 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 or somewhere in between? What's the reaction so far?
Well, let's perhaps just start with, and I'll rephrase it, the drill baby drill approach that Trump's taken to US oil and gas. And so this is about US energy dominance. We've seen some very strong announcements, for example, from the new Energy Secretary, Chris Wright, on this front. Although I've got to say, you know, coming back from meetings across the US on this front from political leaders and also industry it's very hard to see what this deregulatory drill baby drill approach actually means in practice. I've struggled to find a single policy official who can actually describe a very specific lever and what that they're going to pull on the regulatory front, which is going to fix things. So I'll give you an example. Most of where we're seeing announcements or kind of intent is one on deregulation, right? So making it easier to do approvals and particularly permitting. And I'll come to what that means in a second, but also opening up for federal lands. And opening up for federal lands also has a budgetary benefit. The US is currently going through its budget reconciliation process to enable the extension of the tax cuts, which is a huge, for those who are not familiar with the US, is a major deal for this year from a legislative perspective. But what's key to all of that is they need to find budget savings in addition to match some of the spending, and actually opening up federal lands allows them to back some of what they would be projecting as potential tax revenue that comes from development of those lands, which helps that process. But if you actually speak to industry, it's very hard for them to identify, well, here's a well that's not being drilled, but would be drilled but for a change of these regulations. The truth is, you know, there's not a really lot of near-term or even medium-term appetite for drilling on federal lands, even if they were made available. There's right now, a lot of the US supply growth is driven more by the corporate strategies of the bigger players and fiscal discipline and wanting to return money to shareholders rather than regulatory constraints. So you put this together and say, actually, it doesn't look like drill baby drill is really going to work, at least in the near term. Rather, what you're seeing is with WTI prices coming down now, you're into the 50s in the wake of global economic risks, exacerbated by tariffs, and OPEC more rapidly unwinding its cuts. You're seeing rigs already starting to be pulled off, including some of the best Permian acreage. So this is where it comes down to, well, the administration might be telling the industry to drill more in a hope of bringing down prices. But the reality is prices are coming down for some other reasons. It's actually causing the US industry to pull back and contract. And, what we were seeing is what was, the US supply growth increasing by perhaps, 500,000 barrels a day of growth this year. That might be flat or even decline if current trends continue.
And
go ahead. But I think that, that's a very good example of the go and stop at the same time, and the stop's winning at this point.
Absolutely. And what's the case? Is that similar? I mean, you're obviously describing oil here, but what's the situation for gas in the States?
Well, gas is what I think is much more nuanced. And if I could start with what's happening outside the States, because there's obviously a strong connection. So despite oil coming down, LNG prices remain quite tight. And again, this is still due to the aftermath of Russia turning off its gas to Europe, where we've not seen a lot of global LNG supply growth since then. That only really starts to tick up from later from 2026 and 2027. And there's still a lot of latent LNG demand in the world. People miss this, right? When the Ukraine war happened and a lot of supply was restricted into Europe, and as a result, Europe sucked huge amounts of gas away from Asia, causing energy poverty there in order to meet their energy security needs in Europe. What it masked is that latent growth that would be there for LNG, particularly in parts of Asia, if prices were just at more affordable levels. And a really good indication of that was actually about this time last year when prices dropped to around the $8 to $9 just for a very brief period. We saw a massive uptick in demand from China and elsewhere, increasing demand by, 5-10% just in the space of a few weeks. I'm talking about 5 to 10% on a global level, right? So, what we're seeing now is we're still structurally tight in gas. LNG prices versus oil are at extremely high levels, to the point that we should start to see more gas to oil switching in some markets if the capacity is actually available, which is a sign of a very unusual and frankly unhealthy pricing disparity between the two commodities. So that's what's happening in the near term. Now, a few other interesting factors happen here. In the US, we're seeing a big ramp up in US LNG production, but from the US gas market, that's seen as a demand source, obviously. And it's starting to have an impact on pricing there. So we've seen, Henry Hub prices sub 3 for quite a number of years. That's pulled up more recently, both due to some weather and other factors domestically, but also this demand growth from exports. And some of the gas is struggling to keep up. Right. And a big, feedback when you go and speak to a lot of the producers, particularly in Texas and Louisiana, is they're expecting areas like the Haynesville, which is connected to a lot of the LNG plants. This will run through a lot of its tier 1 acreage by the end of the decade. You're then going to go into this 10-tier acreage. And Henry Hub might have to structurally rise from what more historically has been around $3 towards the $4, or potentially have a 4 handle in front of it. And that has implications for global prices, because remember, US is the marginal source of LNG supply. And so if we start to see Henry Hub structurally move towards 4 or above, and at the same time, US LNG building cost inflation has been massive over the last few years. We've seen, cost per ton numbers now above $1,200 a ton, whereas previously we've seen them, $700, $800 a ton. You put these two things together, and the long run price, the implications for long-term LNG prices means long-term LNG has now moved from the $7 to $9 range to the $9 to $12 range. And the market's still towards the low end of that. The market's still in the kind of around the $9 range. But you start to look at these dynamics and say, long-term gas pricing is moving structurally higher into the double digits. And what used to be a floor of $4 or $5, that floor might now be $7 to $9, even when you have oversupply, again, because this latent demand in Asia comes back. The market's not adjusted to this yet, but I think we need to start factoring in a world where the LNG price assumptions that we've taken for granted for really the past 5 to 10 years have moved on. And 10 to 12 is the new 7 to 9. And it comes back also with oil. $50 was seen as the floor where you saw a lot of US supply growth come off a number of years ago. But with inflation, 60 is the new 50. I'm talking about US prices. For global prices, that's 60 to 65. So if we move to a world where 65 is the new 50 for oil, and 11 is the new 8 for LNG. And the implications are massive for the industry itself and for global inflation and energy security.
But in the short term, though, so prices have dipped, have slumped. Yeah. I mean, is there a disparity here is there a kind of disconnect between the medium long term and the very short term impact of the tariff, the trade war issues?
Well, there's always going to be that disconnect. That's the nature of the markets. What's most interesting about what we're seeing with this near-term dip, and it's only happened in the last 2 weeks, is already we're seeing a supply response out of the US. So the fact that WTI drops below 60, and we already start to see initial signs of rigs coming off and industry saying quite clearly that they're not going to be growing supply at these kind of price levels, is indicative about how the long-term structure has changed, and you need these short-term dynamics to show it. Now, given the pressures we're facing in the global macro and what OPEC's doing, can we see oil prices drop into the 50s or into the low 50s? The answer is, of course, yes. But I think what's important to realize is it's not a sustainable price level anymore. We cannot actually maintain current supply levels globally for a period of years in that price range anymore, because the US is still that marginal source of supply growth. But to touch on that short term, so let's perhaps just rewind 2 months. So before the tariff wars took place, where they were just an idea rather than something that was tangible and obviously a lot scarier than many envisaged, the market was actually quite tight through most of last year. We're arguably, in a few 100,000 barrel a day deficit. And then we're looking this year and said, look, even if OPEC maintained all of its cuts, we've got supply growth from outside of OPEC of 1.5 to 2 million barrels. Demand growth is only 1 to 1.5 million barrels. So net, we're going to see supply growth outpace demand growth by about 500,000 barrels at least. And that's going to start to see the market flip from a tight market to at least a balanced market or oversupplied, then factor in that OPEC was planning to unwind over 1 million barrels a day of cuts. And then you can see particularly oversupply venture in the second half of the year. So that was the outlook. And you start to see financial markets really pricing that in from late last year. And then you get this two surprise announcements in the course of a week. One is unprecedented high tariff rates, which is clearly going to have a global economic impact if kept in place, even if it kept in place at much lower levels. And again, perhaps an example of that is in 2019, when the tariff wars under Trump and China played out, you can make a pretty good case that about 500,000 barrels a day of demand disappeared. Roughly speaking, about 0.6% of GDP growth equates to 1 billion barrels a day of oil demand. And this looks to be at least twice the scale of that. So you can see demand, which was 1 to 1.5 million barrels, could be closer to a flatline now this year. And then OPEC at the very same time, everyone's looking to OPEC to say, well, given these demand headwinds in the wake of tariffs, surely you're going to slow the pace of your unwinded cuts or even cut more. And instead, they're more rapidly accelerating their cut unwinds. And you're putting this together, and that creates a more bearish outlook. I think the bearishness is a little bit overdone, and I'll explain to you why that is. First of all, OPEC still holds a lot of the cards here. Right? They are still drill baby drill, as we covered, it's not really working in the US. All the supply growth and control really still is in OPEC's hands. And what OPEC, I think, is doing here is they're saying, well, between now and August, we actually have a seasonal uptick in crude refining demands. And so there's actually space for them to increase this supply more rapidly without flipping the market into surpluses. And then let's wait and see and revisit things towards August and see how the second half plays out. Because things that could counteract this pessimistic narrative include increased sanctions on Venezuela, increased sanctions or conflict regarding Iran. And we could touch on that a little bit, but those two things alone could, tighten the market by 1.5 to 2 million barrels a day, which all of a sudden, everything we just put out there on that pessimistic picture is unwound. There's that type of thing. Plus, it's an opportunity for OPEC to force some compliance within the group, particularly for some of those laggards. It's a bit of a shot across the bow, right? Again, what we've seen in previous downturns was you've seen the main leaders in OPEC take advantage of some negative macro and then compound things, and it forces compliance within the group. So we're seeing a bit of both of that. Plus, I imagine there's some Trump pressure on OPEC to also, increase supply at this time, given the prospect of sanctions tightening and given the prospect that the tariffs are going to be inflationary, this can counteract that. So quite a few things all pointing in this direction. But when you factor then in, actually the market remains tight for the next few months, right? And the oversupply if it comes in the second half, there's still some wild cards regarding how tariffs, global economy and sanctions play out in the second half, and obviously some global conflict areas. I think it's premature to think OPEC's really decided to flood the market and have an all-out market share war. Add in the fact that OPEC can see producers are already on the back foot at 60, and they probably don't have to push prices below 50 to get the supply response that they were hoping to see out of the US and take market share from the US. And I think this view that it's this overly pessimistic view that the market's become entrenched in over the last few months, again, might be a little bit overplayed. It is certainly warranted to a degree, but there's quite a few countervailing facts there.
But if we switch the discussion over to gas, Saul, I mean, what do you see happening next? I mean, there's been a bit of calm now after sort of last week or the roller coaster ride of the last couple of 2 weeks. What happens next in the global gas markets, do you think?
All right, so recapping that, things are still tight in the wake of the Ukraine war. What has changed, particularly since we last spoke, is, and I remember when we last spoke and we talked about market would be tight for a few years post-Ukraine, but then as the LNG supply ramped up, particularly from the Qatar and the US, we could see oversupply eventuate from 2026 through to 2029. That view's changed, right? And I think we highlighted last year why it could change already, and it's playing out now, is supply's late. A lot of the US some of the US projects are late, particularly the likes of Golden Pass. Arctic 2 has not really managed to get cargoes out. Even Qatar might potentially be a little bit late. Plus, again, this later demand and demand resiliency suggests that oversupply in 2026 no longer looks like it's on the cards. It's been pushed out to 2027, and I can make a very good case for why oversupply won't eventuate at all. Right? That's further delays across a number of projects, plus more emerging demand growth in parts of Asia. And if you look at what's happening in the US, there's severe EPC constraints in building these projects. And the next wave of US LNG is now going to be slower and smaller than previously thought. And I'll run you through why that was, because this has all happened the last 12 months. Biden put that DOE pause, or the Biden administration put the DOE pause. It was a political move meant to be only 9 months, that both parties were going to overturn it at the election regardless of who won. But the damage has been so much longer than 9 months. Because what's happened by pausing these projects for only 9 months is massive cost deflation has taken place in the interim. And so all these projects, which were close to ready to go, had long-term contracts signed up with off-takers to underpin their project finance. Well, the cost structure's got up. Those contracts are no longer sufficient to underpin finance. It's having to renegotiate all of those contracts. So you might have had, for example, a toll on your US LNG facility of $2.20. You need $2.80 now. Right? And so you're going to renegotiate this. And some of the buyers, the end users, recognize this and say, okay, we'll renegotiate to $2.80. But there's a lot of buyers, particularly the portfolio players and the traders, who are looking at this and say, you know what, we're not willing to renegotiate the toll higher. We're happy with our our low toll. And then the project comes back to them and says, but then we can't do our project and it dies. And the off-taker says, yeah, we're okay with that too, because if the project dies, it's just good for the overall market and the competing parts of their own portfolio, right? And I'll give an example. As an Australian-based, Woodside's just bought Tellurian, which is essentially a stressed acquisition, and is about to commit within the next month, really, to a 17 million ton project. And they will build, within 5-6 years, that will be 30 million tons, right? Why has a company like Woodside decided to build a US LNG project? And the answer is because Woodside wanted to get US volumes. Went after a number of projects, they're all been delayed or fallen over, and Woodside came to a realization, if you want US volumes, you're going to have to build it yourself. You can't just buy it from someone else. But it shows how a lot of these projects are falling over and delayed, and that next wave of US LNG, therefore, is not coming as quickly. It's going to be smaller. It's going to be later. And again, that tightens up the LNG supply-demand outlook through the rest of this decade. And coming back, I guess, to the tariff side of things, and this is actually a kind of a fascinating dynamic in the moment, because on the one hand, the erraticness that we've seen from the tariff announcements, at least that's how it's been perceived by many LNG buyers, is making the risk premium around US LNG supply security, it's heightened that risk premium. People are a bit more wary about how reliable the US is going to be as a supplier, but particularly because there's risk that as an LNG buyer, your country might place reciprocal tariffs or in return for the tariffs Trump's posing. So that's the one side of things. But the other side of things is, as part of the tariff negotiations, the Trump administration is effectively pressuring a lot of buying countries to buy US LNG to help minimize the trade deficit with the US to aid those tariff negotiations. And so again, it's this push-pull thing where on the one hand, US looks like a riskier place to buy LNG, but on the other hand, there's more pressure to sign up and for a long-term investment and supply deals from the US to remedy the trade imbalance. And if you're a big LNG buyer, how do you respond to that? Do you buy more US LNG or do you buy LNG from elsewhere? And the answer increasingly appears to be you do both.
Mm. But again, so I mean, countries don't buy LNG. Well, maybe some do. I mean, in Europe, but it's companies who do it. It's the portfolio players, it's the traders, it's the big oil and gas majors who are buying the fuel, not countries as such. So, I mean, how does this all stack up?
What you're seeing is, while it is companies, effectively it's countries. So you'll see, to a degree, you're seeing it in Europe where, like, for example, the German government's effectively supporting LNG purchases, but particularly in Asia. Those major Japanese, Korean utilities, some of the biggest LNG buyers in the world, they're inseparable from the governments of those countries. And so it's one and the same. And you will see, for example, the Japanese, the Koreans and others, I think they're going to sign up more US LNG deals. And I think you'll see some of those potentially very soon. But at the same time, because they're more wary of the US as well, they're also looking to invest in and take offtake from non-US LNG. And what you're seeing is a reversal of the trend from 2014 to about 2022, where you saw the big utilities, we want less long-term contracts. We're willing to take more spot exposure. We're going back to the old school model where we better contract a lot more, have equity in a lot more, and actually, if necessary, over-contract our positions, and we can on-sell the volumes elsewhere. Supply security is trumping, small-term kind of optimization in terms of cost management. And that's a very big trend. We haven't seen it in the contracting behavior to a great degree yet, but you're starting to. And for example, JERA's purchase of the Scarborough LNG project last year, I think is a signal of how JERA, being the biggest, biggest LNG buyer in the world, they're back to taking material equity cheap pieces, not just small ones, and long-term offtake. And I think you'll see the likes of them do that more both in the US and outside the US in the wake of these tariff negotiations.
No, fascinating developments here, absolutely so. And I think just to sort of round off or bring it back, the discussion back to Europe as well. I mean, there's been a lot of focus on the price spreads between the summer and the winter contracts in Europe and the difficulty of filling the storage. I mean, what's your view here? I mean, there's talk of the policy, the regulations being a little bit more flexible in terms of the actual target, but also in the time frame. What's your view? Will Europe struggle to fill the winter storage for the winter 25-26 in the current market conditions and the geopolitical reality?
Well, I think actual physical shortages are very unlikely. They're reasonably well placed. Again, we actually do have some LNG supply ramping up, particularly in the second half of this year, which is going to aid that. I think we mustn't be complacent, though. It does mean a period of more elevated pricing than otherwise would be. And more elevated pricing means shortages. It just means not shortages in Europe, it means shortages in countries that can't afford to pay, particularly, for example, in South Asia, right? And, this is not it's good for the industry in terms of their profits, but it's not good overall. And, this is the kind of pricing you want to see to incentivize more supply. And that's why it's been so unhelpful to have, for example, that Biden pause last year, which restricted a lot of that supply. I think, what we are watching very closely in Europe is if there is some sort of ceasefire with Russia and Russia makes gas available to Europe again, what is the level of appetite from Europe to take those volumes. And I think one of the fears for the LNG industry, and particularly more pronounced in markets, in financial markets than in industry itself, is every indication is, even if there was a sustainable ceasefire, and that's an if, and even if the gas was made available, and that was an if, Europe would take a small amount of volume, but not allow itself to be anywhere near as reliant as it was in the past. But one of the fears in markets is that's a nice position to take now, but as time passes, we're taking a little bit more and a little bit more and a little bit more. Russian gas become increasingly attractive, and it starts to displace some of the LNG demand. And we end up back in the situation we found ourselves in 2022 in 10 years' time. And I hope that's not the case for geopolitical reasons, in addition to the health of the global LNG trade. But it is something that is weighing on financial investors' minds right now.
And there's certainly this over-dependence and reliance on very unpredictable and very sort of unstable providers of LNG. I think that's the new reality here, isn't it?
It is, and again, coming as an Australian, Australia went first in 2022 where a new government took more hostile policy action towards LNG development. And Australia's long-earned reputation over decades as reliable supply was brought into question. Now, fortunately for Australia, Australia's now seen as a relatively more reliable supplier, but that's unfortunate for the industry because it's not that Australia is getting better. It's that the political risk, the above-ground risk profile for LNG suppliers across the world is now rising. Everywhere seems to have high political risk. Everywhere seems to be not as reliable supplies as it has been in the past for various domestic and geopolitical considerations. And what that means is you now have to put a premium on security supply beyond what was there in the past. Prices have to be elevated on average beyond what they otherwise would have been. And, just as I think the Ukraine war and some of the developments in the Middle East have seen the peace dividend dissipate, and that has implications for overall costs and budgets for defense around the world. The security of supply dividend we've seen from LNG has dissipated over the last few years, and that's going to see elevated costs to ensure there's more supply that's contracted and needed, more built into your logistics and supply chains, and ultimately it's results in higher prices and higher costs across the globe. And all trends that we've seen, including the tariff trends over the last few weeks, are continuing to support things in that direction.
So, I mean, I could sit here for hours discussing this, but we've got to come to a close now. I've only covered maybe a third of my questions, but a fascinating discussion, and certainly I think one thing's for sure that we'll have a lot more unpredictability and volatility going forward. So thank you very much for joining me on this episode of Plugged In, and hopefully we'll have you back again soon to discuss the wider ramifications maybe by the end of the year or early next.
Thank you. Always a pleasure.